Most investors don't fail because of bad stocks. They fail because of fear, impatience, and chasing the wrong opportunities. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend podcast. In today's episode, I'll show you how to master the psychology of investing, how to stay calm during market crashes, avoid costly mistakes, and build wealth with patience and discipline. If you've ever wondered how to ignore the noise and invest with confidence, this episode is for you. Dividend investing isn't just about numbers. It's about mindset. Today we're talking about the psychology behind staying the course, even when markets test your patience. Today's topic is even more important than ever. In July 29, this summer in 2025, there was an article written by Mark Hulbert at MarketWatch, and I just want to share with you three things that came out that were specific in this article that I think are very important. So Mark Hulbert writes, the stock market is more overvalued than at almost any time in US history. The second point is, in other words, he says, today's stock market isn't rising on fundamentals or interest rates, but on something else. And the final point Mark suggests is that the latest readings, therefore, and I quote, point to disappointing stock market performance between now and 2035. Now, I know that's a long period of time, 2035, but stock market things can move quickly, and the article by Mark Hulbert at MarketWatch is very important in that he's pointing out that we are at a critical stage here where the market is very overvalued and we should expect a market downturn, which is why today's episode is more important than ever. So in today's episode, I'm going to cover the following 5 topics. We'll take a look at why psychology matters in investing. Then we'll take a look at some of the common psychological traps. Then we'll take a look at the dividend investor's advantage. Then I'm going to give you some strategies on how to stay the course. And then we'll end off with 3 real-life examples. Let's get started with our topic number 1, why psychology matters in investing. And the biggest reason is because investing is 80% behavior and 20% knowledge. Now here at Simply Investing, we have a Simply Investing dividend course. We focus on the knowledge side of things, mostly teaching you the fundamentals and how to select quality dividend paying stocks. But behavior is just as important. And that's what we're going to talk about in today's episode. So the markets will always go up and down. Stock prices go up and down. The challenge is controlling your fear and greed. Let's take a look at this graph. It's up on the screen right now. This is the Dow Jones Composite Average Index. And what I'm showing here is starting in January 2019 and then going up to about March of 2020. And that's when COVID was at its peak. So COVID hit, and in March of 2020, you can see that the stock market tanked. So for those of you that are watching, you can see the graph goes like this, and then there's this pretty much a straight line all the way down. And that can be very scary. When you're looking at that and you're looking at your investments, whether it's mutual funds, index funds, ETFs, or individual stocks, this can be very scary to see and experience that yourself when you see the net worth of your investments drop so significantly in such a short period of time. Now, of course, if we zoom out a little bit and we continue to look at the graph, and now you see that the graph continues well into May, September, October, and you can see that the stock market actually ended the year higher than when it started. And that's even between having sort of COVID at its peak in March of 2020. Now let's take a look at a very quick example. We're going to look at the stock Nike. Everyone's familiar with the brand name. And you can see here, again, we're looking at the same time frame between January 2019 and the end of 2020. And again, you can see there's a big green arrow that shows you the drop. And so Nike, like every other company, when the stock market tanked, the stock price dropped. And that was a significant drop. We can see just a couple of weeks earlier, the stock was trading at over $100 a share. And during COVID in March of 2020, the stock dropped well below $70 a share. And that was a significant drop. Now, specifically, we can take a look at the numbers here. In January of 2020, the stock was trading at $104. And by March of 2020, at the end of the month, it was at $62 a share. That is a 40% drop. And that is significant. And again, I'm going to repeat this again. If you're looking at that time at your holdings and your investments and you see a 40% drop, it's very easy not to panic. Now, again, you can see with Nike, if you held on to the shares, they actually ended the year much higher than when they started the year. And the stock price was at a little over $141 a share. So the important lesson here would have been to just hold on to those shares in Nike. Because remember, when you sell at a loss, that's when you solidify your losses. If you just hang on to those shares, even though the stock price is down, you still own the same number of shares. And we're going to see in a little while, you're also going to be getting dividends. So the dividends still keep coming in. You still own the same number of shares. The stock price was down. It was only down briefly, and then the stock price came back up again. So had you sold when it was down, you would have solidified a 40%, a negative 40% loss, right? So that's one of the lessons here is you want to hold on to the long term. Now let's take a look at a few other common psychological traps. So the first one is going to be the fear of loss. And we see that all the time. We saw it during COVID. We saw it during 2008-2009 financial crisis. We saw it during 9/11. We saw it when the tech bubble burst in 2000. And so there is a fear of loss. And when people see the price of their investments dropping, again, individual stocks, could be mutual funds, ETFs, or index funds. When people see the value of those investments dropping every single day, fear sets in, and that's when you sell your holdings because you don't want to lose any money. Now, you're selling it too soon because if we saw in the example with the Dow Jones chart, we saw with the example with the Nike chart, stock prices come up. And you can see that after every market crash, after a couple of months, maybe a year, stock prices come back up. And they've done that consistently after every market crash and market downturn. So you want to be aware of this psychological trap where you get into a lot of fear and you start panicking and you sell too soon. So we don't want to do that. Number two is chasing yield, the dividend yield. And it's easy to get tempted by investing in stocks that are very high dividends, that are giving you high dividends, but they're risky. I'm going to give you a quick example here. So this is a screenshot from our Simply Investing web application. I'm just showing you just a couple of examples here. There is a much bigger list, but you can take a look at these stocks here. To be honest, I've not heard of these companies before, but you could take a look at the current dividend yield as of this recording. So there are stocks here that are giving more than 15% dividend yield, 14%, 13% dividend yield. Now you'll notice there's a little icon there, DT. We call that a possible dividend trap. So we have ways to mitigate that. So that's why that's there up on the screen. I'm not going to read out the names. You can see them up on the screen here. But what I want to point out here is that the dividend yield is very high. And I've seen people people have emailed me. They said, well, why should I invest in a company that's giving me 4% yield when I can make 15% with some of these companies on the list here, right? So there is a risk there. And we cover that in detail And I'm going to recommend you go back, if you haven't watched it, go back and watch episode 10. And we talk about dividend traps in detail and why you should avoid them. So that's another trap that people get caught into and investing in very high risky dividend stocks. The next thing is being impatient. That's another psychological trap where you're expecting quick results in a short amount of time instead of slowly compounding and letting the investment grow over time. So you have to be patient. I said that at the beginning of the episode. That's important. An important attribute that you need to have if you want to become a successful investor. And the other psychological trap is the comparison trap. This is where you're watching your friends boast about growth stocks or crypto or AI or whatever the latest hype happens to be. For a little while, it was electric vehicles. It was anything to do with electric battery packs that cars were building. Then we had crypto. Then it was AI. Every couple of years, there's a different hype that everybody jumps on the bandwagon. And this is very difficult to avoid because if you're on any of the social networks, whether it's X, Twitter, Instagram, Facebook, anywhere, you're going to see other people, maybe even your friends, boasting about how they doubled or tripled their money in 2 months. And here's a good example. This is thanks to our friends at tradingview.com. That's the source if anybody wants to go look at it. What I've done is I've just selected the top 5. And as of this recording, these top 5 companies have the highest performance of the past year, the past 12 months. And again, I'll be honest, I have not heard of these companies before, but the performance is incredible. Look at the one at the top of the list, over 6,000% return in 1 year. Then we have 3,000% return. We have over 2,000% return, right? Of course, everybody wants that. I would like that too. I would like my stocks to go up 2, 3, 4, 5, 6,000% in 1 year. Okay, but these are going to be risky because they come down and crash just as easily as they go up. And what are the fundamentals? Are these companies profitable? Do they have a record of profitability? Do they have high debt or low debt? Right? Do they pay dividends or they don't pay dividends? These are all the things we need to consider. Are these stocks already overpriced and overvalued, or are they priced low? So just the fundamentals, the basic questions that you have to go through. Are these companies recession-proof? Are they still going to be around 5 years from now? So those are all the questions you have to ask and not just look at the performance, right? And now it's already, in this example, it's already too late. These companies have already a 6,000% return in 1 year. How much higher is it going to go? But a lot of people will jump on these stocks because they see that the performance has been incredible and they will automatically assume that that level of high performance will continue. It may or may not. So that's something that you want to consider. And I highly recommend, if you haven't seen it, go back and watch episode 112. And in that episode, I go into a little bit more detail and we compare the performance of dividend stocks versus the performance of growth stocks. And then we compare the pros and cons of each of those approaches. So I highly recommend go take a look at episode 112 for more information. Let's move on to our topic number 3, the dividend investors advantage. So there's a couple of advantages here. One is that the dividends provide steady income, which can help calm nerves during a market crash or a market downturn. For those of you that don't know, a dividend is a company sharing its profits with you, the shareholder. So it's a share of the profits, right? So if a company is offering you a dividend of $1 per share, you're going to get a $1 in cash deposited directly into your trading account every year for as long as you own those shares and as long as the company continues to pay the dividend. So every time the company pays a dividend, that's money in your pocket. Every time a company increases the dividend, that's more money in your pocket. The other advantage as well here, unlike speculation, dividends remind you that your investment is working for you, even in a down market. I'm going to give you a quick example here. So remember, we were looking at the Nike stock price during COVID, and we could see that, if you bought it in January of 2020 and then sold it in the peak of COVID in March of 2020, you would have lost 40% of your money, because that's how quickly the stock dropped. Now, if you held on to it, the stock ended the year much higher. Now, even more important than that is the dividend income. So now you can see up on the screen, we're going to go back to 2019. We're not going to go back even further than that. So 2019, I just picked it because it was the year before COVID, and you can see that Nike was paying a dividend of 86 cents a share. And then even in 2020, with COVID, the company increased its dividend to 95.5 cents a share. And then you can see, I'm not going to read them all, but you can see on the screen, the dividend has gone up every single year. And as of this recording, it's over $1.57 a share. So the dividend has gone up. Even during COVID, this company increased their dividends. And remember what I said, every time the dividend gets increased, that's more money in your pocket. So your dividend income goes up every single year. Nike, in fact, has had 24 years of consecutive dividend increases. Now, if you think that's impressive, we have a couple of examples here of even more impressive track record. Now, again, this is a very small list. We're just going to show you 6 companies on the list here. Let's take a look at the one at the very top, American States Water. They have had 71 years of consecutive dividend increases. The Dover Corporation, 70 years. Genuine Parts, 69. Procter & Gamble, 69 years. Coca-Cola, 63 years. Colgate-Palmolive, 62 years. Think about how many recessions, how many market downturns we've had in the last 60 and 70 years alone. But yet companies like this up on the screen, and there's more than just the 6 here on the screen, have continued to not only pay you a dividend, but also increase it year after year after year. So that leads up to our third bullet point up on the screen. The other advantage for dividend investors like us, historically, dividends have contributed anywhere from 30 to 40%. Some estimates go as high as 45% of total market return. So it's not just the stock price that you should be looking at. Of course, you want to buy low and sell high, but the dividend has a big contribution into your total market return. And so that's one of the advantages we have as dividend investors. Now, there's a couple of more advantages. I recommend you go back and watch episode number 14, where I cover the 6 key benefits of investing in dividend stocks. Let's move on to topic number 4. I'm going to give you some strategies to stay the course. Number 1, you got to focus on the long term, 10 years or more. And I say this to all of our students, if you're going to invest in the stock market, whether it's individual stocks, mutual funds, index funds, or ETFs, if you need that money in less than 10 years, you probably don't want to put it in the stock market. Because if you're saving for a down payment on a house or a car or a vacation or education, and you've got $10,000 saved up and you're expecting that in 3 years that $10,000 is still going to be there, and you invested in the stock market and now it's only worth $6,000, now you're stuck, right? You need the money, and if you sell it, you're only going to get $6,000 back. Now you've solidified your losses. So because the markets go up and down, stock prices go up and down, we want to be invested for the long term, because in the long term, we can see that the market does this. So for those of you that are listening to it, you can't see, I'm taking my hand here and I'm drawing a graph that goes up. It starts at the bottom here, and over the next 10, 15, 20 years, the graph is going to go up. And so that's what we want to see with your investments. We want to see them grow. So focus on the long term. Don't panic about short-term fluctuations. And you want to reframe the volatility. What I mean by that is, think of market drops when the market crashes, not as a bad thing, but as a buying opportunity. Because if nothing else has changed, if the company is still profitable, if the company still has low debt, it's still a recession-proof company. They're still consistently growing their earnings, right? If nothing has changed, except the stock price is now down because the stock market tanked, or because some famous person or politician or famous analyst said something on online that made the stock prices come down, that could be a good buying opportunity because the stock price is going to be low. Remember, we said buy low and sell high, but also because it's low, you're going to be able to buy more shares. And if you can get more shares, you're going to get more dividends because the dividends are paid out based on the number of shares you own. And the other thing is to focus not on the stock price, but on the dividend income. This is going to help keep you grounded. The other piece is set the rules and stick to them. I'm going to cover those towards the end of this episode. We have 12 rules to help you and guide you. And so you stick to those rules so you don't stray off course. And then you want to ignore the noise. That's going to be very hard. There's a lot of noise out there, whether it's online, in the news, on the radio, any kind of media. You want to ignore the noise and focus on the fundamentals. And we're going to give you the 12 rules, and you should just focus on those. And then finally, the last piece is you want to remain patient and disciplined. Patient so that you can ride out any market downturns, and disciplined so you can stick to the 12 rules and so you don't jump from one strategy to the next. Now, our final topic in today's episode, we're going to look at 3 companies, some real life examples, and we'll see how they perform and what it's like to invest in dividend paying stocks. So we're going to look at our 3 companies. It's going to be Nike, Procter & Gamble, they're the makers of Tide and lots of other products, and Home Depot. So we're going to imagine, as an example, let's say you invested $10,000 in each company in 2015. Now, of course, this is just an example. You could scale it down to $500 each or $1,000 each. Just to keep it simple, keep the math simple, we're going to stick with $10,000 just as an example. So let's say you invested in each of these companies back in 2015. So as of this recording, we're still in 2025, so it hasn't even been 10 years yet. So less than 10 years in 3 companies. Let's see how your investments would have performed. So let's take a look first at the dividends. So we can see Nike, as I showed you before, in 2015, the company was paying a dividend of 54 cents. The dividend today, and this is the annual forward dividend, today is $1.60. Procter & Gamble was paying a dividend of $2.59. Today it's $4.23. Home Depot, impressive dividend growth. It started in 2015 with $1.88. Well, the dividend started much earlier than that, but in 2015 the dividend was $1.88. Today it is $9.20. And for all of these 3 companies, they each have increased their dividend consecutively for decades and decades. Now let's take a look at, again, the 3 companies. We're going to invest $10,000 each. The value today is as of this recording, and so that includes the capital gains plus the dividends received since 2015. So Nike, you invested $10,000. Today it would be worth a little over $19,100. So not bad, almost doubled your money. Procter & Gamble, $10,000 invested in 2015. Today would be worth over $23,800. And Home Depot, same thing, $10,000 invested in 2015. Today would be worth over $46,150. So that's impressive growth, again, including dividends, plus the stock price appreciation. If we add it all up, this investment would have been a $30,000 investment back in 2015. Today would be worth a little over $89,000. Now you can see on the screen, we've added an extra column to the table on the right. I'm showing the return of each of the individual stocks. So Nike would have returned over the last 9 years, 91%, Procter & Gamble 138%, and Home Depot 361%. Now let's take a look at the dividend yield on cost, because the dividend has gone up for each of these companies over the last 9 years. So Nike today in this example would be paying you 3.51%, Procter & Gamble 5.2% return, and Home Depot 9.11%. And that is the dividend yield on cost, because the stocks were purchased back in 2015 and the share price was a lot lower back then than it is today. And then finally, we can take a look at the annual income, the forward annual income this year alone. So Nike would generate, again in this example, would generate for you $351 in dividends. Procter & Gamble, $520. Home Depot, $911. So total, these three companies with $30,000 invested today would generate this year would generate $1,782 in dividend income. Now, if you're interested in learning more about other dividend stocks that have provided extraordinary returns over a longer period of time, I highly recommend you go back and watch episode 7. So does this mean that you should go invest in any stock that pays a dividend today? And the short answer is no, right? There's a couple of things we need to look at. Remember, our approach to investing is to keep it simple. It's to help you build a resilient portfolio that provides you with growing dividend income each year. So how do we do that? We invest in quality dividend-paying stocks when they are priced low. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock? And how do you know if it's priced low? So for that, I've created what I call the 12 rules of simply investing. The rules are designed to lower your risk, save you time, and help you earn more. You can see the 12 rules up on the screen right now. And the way this works is you want to invest in a company if it passes all of the 12 rules. If it fails a rule, skip it, move on to something else. Rule number 1, do you understand how the company is making money? Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is the company profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any companies with a recent dividend cut. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? And rule number 12, keep your emotions out of investing. So we have an all-in-one solution that includes the Simply Investing web application and the Simply Investing dividend course to help you become a successful investor. The Simply Investing web application, you can see a screenshot here. Basically what it does is it applies the Simply Investing criteria to over 6,000 companies in the US and Canada every single day. So you can quickly see which companies to focus on and which ones to consider and which ones to avoid because they might be priced too high. So the investing app is going to save you a lot of time. The Simply Investing course is an online course. There's 10 modules. It's a video course. You can take your time, go through that. Module 1, we cover the investing basics. Module 2, we cover the 12 rules of simply investing in detail. Module 3, you learn how to apply the 12 rules to any stock anywhere in the world. Module 4, you learn how to use the Simply Investing web application. Module 5, you learn how to place your first stock order. Module 6, learn how to build and track your portfolio. Module 7, you're going to learn when to sell, which is just as important as to know when to buy. Module 8, learn how to reduce your fees and risk. Module 9, I'm going to give you your action plan to get started right away. Module 10, I'm going to answer your most frequently asked questions. So if you're interested, you may want to write this down. We have a coupon code, SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. So that's access to the web application and the Simply Investing dividend course. If you enjoyed today's video, be sure to hit the subscribe button, hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.